Hello, how are you, investors? So, in today's video, we'll cover the Amazon stock. The ticker name is AMZN, and myself, Pramod Kumar. I am a CFA charter holder and FRM certified. And this is my website, https://riseanalytics.ca. In today's video, we'll for sure use the models like net profit model, enterprise value models, and free cash flow model to come up with our intrinsic value of the stock to compare. But also we look into the first the revenue diversification. So from where the revenue is coming, which business is doing well, which is not doing well, what are the top level returns, and what are their its margin, right? So because this is a very big company, global company, very growing growth company, so I believe we should be looking from all the aspects of it to see if our long-term investments is good or not. So let's get started. So in Amazon business, so basically their business is categorized into the three main categories, right? How they put the revenue into these three categories bucket. So first is the North America business, and then they club all other outside business to the international sections, right? The the third category, which they have AWS. AWS, as you know, is their Amazon Web Service, or is the cloud business. So cloud business seems like is very interesting. They kept it separate, right? And all other business like fulfillment and whatever they are doing, their traditional business, is all clubbed here. So these are the dollar amount, and for sure when I do the models, I'll not only use the 2 years, I'll use the from 2010 to 2019, so total 10 years of data. So if I see, the main thing which I like to highlight here is this is increasing pattern. So this is 2018 to 2019, and the revenue is in millions, right? So that lot of money is coming to Amazon, $232 billion, and these are not small amount of money, right? And this is, and in the next year, in the 2019 10K, it's $280 billion. And I also checked from the coronavirus impact, like their quarterly statements, Q2. So it doesn't impact their earning. Their earning is quite good. So the year-of-year percentage growth, this one I don't like it. So if you can see, the year-of-year percentage growth is, if I compare to the last and this year, it's the revenue is declined, right? It's from 21% to 31%. And the international, so this is the traditional one, and their cloud business, which is they are hugely betting on, is also declined by 10%. If I see this without, because usually their business is, this is an international company, and let me put myself on hide so we can see clearly. So this is an international company, and their business is all over the world, right? So it has the, then from there they need to convert into the US dollars. So depend upon the FX rates, that number get fluctuate. But if I just even exclude the FX rate effects, then even the cloud business is 10% decline, which clearly seen here. So it seems like their majorly cloud business is in North America. And we'll see how much costs to come up these as well. And then pretty much on the net side, if they do the net side, then with the FX and year over growth, then it's not much difference. Maybe something is covered by the FX, some is not. This screen is totally copy paste from their 10K statements. Okay. Now, if I see from the cost perspective, then let's look into the percentage of the cost, right? So the percentage, again, the cost increase for sure if the revenue increase. But if you noticed here, they have the huge cost in terms of the fulfillment and the cost of sales, right? If you see, the total cost is around 59% here, right? And if I see here in 2018, but which is remarkably year over percentage growth, right? So this is reduced, if I see, which is a very, very good sign. So they can able to reduce the cost, right, by that. But if I see from the percentage of sales, so year over year the cost is reduced. But if I see from let's say from this one, right? So from the net sales perspective, so how much revenue, how much cost it takes to generate 100 and let's say 265 billion dollars, right? In terms of expense. So how much, if I break down these expense, this will come as in terms of the net sales, which is 280 billion dollar, right? So break down the cost. So the cost comes here is 14.3 and 12, so which is keep consistent. But one thing I really like to see is their AWS business growing, because the cost for this business is very less, is 12.8%. In the cost section, they put under the technology content the AWS rather than mark as AWS. So that's why I put a comment here. And also I notice in their the one of the reason to have their lower sale, the growth rate in year over year lower, 10% lower, is they didn't mention any the new acquisitions of the customers first, and whoever is their existing customers, they need to do a price down. So that's what it's mentioned there. So it seems like they're trying to retain the customers and giving them extra deep discount. So that's why their margins is slipping here. Okay, so that's from there the total business and where the revenue driving from. So let's quickly look into the top level returns. So if I see this top level return, which is the return on investment capital, return on equity and assets, seems like really the business get picked up from 2014, right? And now if I see in the year end of 2009, so this is on 19. So we have, I've seen that, okay, this is going to over 20% growth in terms of the return of equity, right? But the return on asset is still over investment capital is over 10%, which is not bad. The main thing which I believe is driving them is the huge amount of revenue which they can bring. So even if that there is a very small percent they are keeping, it's still very high. And the main thing which we can also, that's why even of the small percentage, like their operating margin is close to this 5. So this is the operating margin. If you can see here is just shy from 10%, but their net profit margin is over 4%. So it's not that great in terms of the percentage, but that's again, right, $280 billion of revenue is coming. And if from that, if the bottom line is that, and the pace they are increasing, look at the spike, right? Just from last 2 years is consistent, but otherwise a huge jump there. Same thing on the cash flow chart. I can see, okay, is like a keep increasing like a slide, right? This is the new TTM, and this is December 19. So this is increasing. The liquidity side, so I think and once I done, then I'll just come up on the other side. On the liquidity side, the business is doing well as well, so you can have a look. So basically it's over 1, so the company has enough, which we can also see from their cash. But this is another way. If you don't understand how this liquidity and other ratio work, so you can check out my channel. I have a separate videos on that. The risk, where I try to see not major risk, but one thing to point out, that company is has some debt. The fair value of debt right now is $27.8 billion as per 19. And these are unsecured debt. So this means the company is paying a little bit higher in terms of the interest rate, which I can see the maximum they are paying 5.2% of in this 2025. Okay, so that's it. But I didn't consider it as major because they have very huge pile of cash flow, right, sitting or coming from their business. Okay, so now we have all this information. So we understand from the revenue perspective, we understand from their margin, we understand their liquidity. So let's go to the model and see. Looks like it's pretty good from all those angles. Looks like, let's see what the models are giving in terms of the price, what price we should take to enter into if we want to. So if I go to the net, the profit model, so I have taken the 10 years of data from, and then this is the revenue year over year it's going, right? Look at its the 10-year the CAGR growth rate is year over year is 23.42%, which is even consistent, because most of the time I see the company, they slip the growth rate to half the recent 5 years, but seems like the company is still maintaining the same pace. So it's really clearly seen the growth company, and which truly confirms when I see that bottom line as well. And the bottom line, the net profit margin for the last 5 years is increased from 81%. So that's a huge amount of the growth in terms of the bottom line, right? So that's why when I take the net profit growth rate, I just take the weighting between these two and come up with 59.01. I think from my perspective, it's not fair to use very low growth rate of 25, because when the company is in the recent past is doing 81% year over year growth rate, but still I'm not very optimistic, so I give a discount of 20, almost over 20% discount on the growth rate, as you can see. And then I just bring this down. Okay, and then I have used the long-term growth rate as usual, 2%, although we can use higher as well, because this is an international company, but a little bit more conservative. And not only that, if you are following my videos which I have done earlier, like Walmart, Adobe and others, you can check out on my stock valuation playlist. So there I have consistently dropped the growth rate, right? So I'm not just keeping this growth rate, but I am dropping the growth rate as well. And then when I look into the current PE or industry PE is pretty much it's very high for these over 10 billion kind of a net retails company. So therefore but still I'm conservative, and I use the terminal value, which is of S&P 522, right? Although I can easily use a higher number as well. So as you can see, I take this number and multiply by this to come up with the terminal value. To come up with the net profit margin, net profit growth rate year over years are increased from 1 to 10 using the current year growth rate, and then apply this growth rate here. So it's nothing but, if you can see, I take this and multiply and so on, previous year, and then I discount it by each year by the present value, by the 10%, right, for each years, to come up with the today's terms. When I did all, I got the 1.7 trillion in terms of the market cap, and then my share outstanding here is only 498 million. So when I take everything, when I take this the company value which I have calculated, right, for the next 10 years, and then divided by in the present value terms and divide by the number of share outstanding, what do you think? Any guess? If you want, you can pause the video and do a guess, but for sure on the YouTube I don't want to pause it. So I got a $3,507.78 is my interesting value, and which makes sense because of the rate the company is doing growing, right? Okay, so let's go on 2 more models to go, and then we'll see the price. If I come to the enterprise value model, so if we can easily see the enterprise, again I have a same concept, 10 years growth rate, then enterprise value is pre-computed here, and it's come with a 10.4% growth rate, and again it's consistent with which we have seen in the net profit. In the last 5 years, the growth rate even is increased by almost 50 basis points, right? So it starts from $101 billion to $273 billion. It's a very good growth. If I see from the operating cash flow to EBITDA, it's amazing, right? So if somebody goes today and buy the whole company, right, they can recover it based on their operating cash flow. They can recover that within less than 7 years, right? As used to be 48. So look at the power of the Amazon. It's clearly shown here. The debt ratios was very low, but it's not very high as compared to the debt over EBITDA is less than 1, which is very good. The growth rate here I have used is the 10 years, which is in 5 years pretty much on the operations is consistent. So I have taken the 10 years, and the long term again is 2%. Then I have grown my EBITDA for the current years to the this $37 billion, and then times this growth rate comes to the 49, and then keep growing that to the given growth rate, and the growth rate is decline as well. Here the terminal value I have taken below the average, right? If you can notice, it's average EV over EBITDA, but I have taken 17 here. So again, so I grow it by until 10 years, and then I try to sell the company by this 17 times, right, of the last 10 years operating cash flow. So you see, this is less, this is times this, and come up with this valuation. So with my second model, when I sum it and divide by the number of share outstanding, I get even higher the number, $3,800.36. Let's say what's the free cash flow models, give it to me, and then once I have these numbers, then we compute the price. Okay, now this is the free cash flow model. Here, as you can see, I have computed take the operating cash flow for 10 years and the capital expenditure, and then come up with the free cash flow, right, which is seen here. The price over the last 10 years based on these dates are given, and based on that I have computed the free cash flow yield, right? So basically, for example, how much the cash flow is generated by the given price, right? So which is, if I see the free cash flow growth rate is again consistent. I never see in any of the companies so far that even the growth rate is increasing and the cash flow growth rate is also like in that high double digits and all. But it's very good. Average cash flow yield I have is given here is 1.83. I have used this just to be very and today to come up with my terminal value of it. So I'll show it to you. So again, I have taken the current year cash flow, free cash flow, and then grow by the 24 and then 21 and then last 2%, which is a very conservative approach. And the last the terminal value I have taken the maybe I have taken the last 5 years just to be conservative, little bit more, right? Okay, so when I do that, so I come up and I divide this by the number of share outstanding, then I come up with the $3,200 dollar price value, right? Usually that's okay, because that's reflects the free cash flow growth and the yields. Okay, that's good. Now we have all three number, and hopefully let me come back as well. So we're excited. So we get the number from all three models, which is looks in the 30 over 3,000 range. But when I divide this by equal weight, I get my price. But be careful, I have a little bit surprise today as well. So I get this number, right, 3,500. But when I compare to the market share is still over $3,000, right? Now, as an investor and as the rational investor, right? So this is not the price we go in, right? For this one, we need to take some margin of safety, right? The margin of safety of usually I take 20%, but since I have seen the risk on the company, right? Basically because of the higher margin of safety is from the lower the margins, what will happen, and the lower the price of the AWS, lower the margin in terms of the pricing. Although the revenue is increasing and everything increasing, that's fine, but we need some buffer of the safety, right? We cannot just go there. So my expectation is, if the price for me at least, right, if goes around this, maybe maybe in the last quarter, I can tell you Amazon can do even better. Because why? Because of the seasonality component, right? Christmas and other, and that's mentioned in their 10K as well, this sales. But it should but as a rational investor, we need to have some safety, right? Because it's a risky, it's a little bit risk. I'm sure I'm seeing. So anyway, so that's everybody has different point of view, and that's my point of view. So this is at the end, my final price on the entry price here is $2,400 rather than I go for 3,000. Maybe you have lower margin of safety, you have different price, but you can go from there. So now let's see what you can think. Do you think this is a good stock for you from the long-term perspective? Do you think you enter at the $2,400 price range, or are you willing to just get into the consistent whatever the price is showing, and then you think it can grow even higher? So let me know in the comment below, and let me know as well which other stock do you have. And please do give a thumbs up to this video, so Google algorithm think this is a good video, and more it promote as well. And if you want me to cover, if you're new to the channel, kindly subscribe. And if you want me to cover any other video, please kindly put a comment there. Okay, thank you for watching this video. I really appreciate you given your precious time to me to look into this video, and see you soon in the next video. Bye for now.